Safe, simple, and secure. Just got off the horn with a guy today. Great guy down in Florida. Man, I work with so many people. Just freaking guy's gonna get his butcher to send me some beef that he loves. I mean, the guy paid me money, and now he's going to have his butcher send me some beef. Dude, how the hell did I deserve this? It's nuts. It's crazy. Anyway, it was interesting too because he was just telling me, it's like, look, I wasn't saving that much. Then I, the latter part of his career, started making some money, started putting some money away, and now he's doing okay, and he's doing better than okay. Yeah, I just love it, man. I love the people I deal with. I've had a couple assholes, not many. That's just awesome. Anyway, so what the heck? What? So here he is. He's all in T-bills. 1.5 million or so. Can't remember. 2 million, 1 million. I forgot. All in T-bills. 4% is what we're showing in Right Capital. Hold on. I'm going to take you guys with me. You'll see my routine. 4% Right Capital. All right. Standard deviation is 5. So that means on any given year, his portfolio value could be down 11%. All right. I don't expect that, but you don't know. I mean, that's volatility. Doesn't mean you lost money. It just means it's down. That's all it means. And can T-bills lose value? Probably not, because they're only 13 weeks. Not very much volatility there. But be that as it may, we'll just say there are. Give me a second. All right. I'm gonna get my devil horns. Ooh, I'm Fauci. Anyway, so here is a moderate portfolio. And whenever you see target allocation, I always tell people it's not targeted for you specifically. I just like to show you what a typical 60-40 portfolio I would expect would do. 5.3% rate of return with twice the standard deviation. But standard deviation isn't a good measure of downside risk. Yes, it is. It's absolutely a great measure of downside risk. 100%. Come on. It's just, people in my business, they want so hard to be the smartest guy. You should use, okay. So this means on any given year, he would average 5.3%, but on any given year, he could be down 25%. On any given year, we expect him to average 4%, he could be down, 11. That's all that means. So we're going to say we'll sacrifice 4% to get a 5.3% return. In return, though, we're going to increase our downside risk from 11 to 25. Yeah, let's not do that unless we need to. Well, this guy doesn't need to. When he's like, I'm spending buku bucks. Like, dude, we'll call him Bob. Just, you know what I'm saying? It's like, why take the risk? And so he asked, he goes, when should I get back to the market? I said, Bob, I don't know. I don't know if you ever need to. Now, two things are going to happen. Long-term rates are going to go up, or short-term rates are going to go down. This inverted yield curve can't stay like this forever. I guess anything could happen. I mean, I guess it could. Japan has stayed a long, long time. Actually, I can't remember if it was inverted, but long-term rates they had they had NIRP, negative interest rates policies on long-term debt. So I guess it probably could. I guess it could have stayed at inverted yield for a long, long time. I don't see it, but I didn't think it could happen. Anyway, so the long story short is you have higher short-term rates, lower long-term rates. Now, one of two things is going to give, in my opinion. They're going to, I guess 3 things. They can flatten out where they are equal. I don't see that. Again, I don't see inverted yield curve staying like this for many, I don't know, maybe a year. I don't know. But so we're not going to have an inverted yield curve, short-term, long-term, for a long time. I wouldn't expect. I don't think they're going to be flat, where you get 2% for the short and 2% for the long. That doesn't make any sense. So what's going to happen is either long-term rates are going to jump up higher than short-term rates, all right, to make it back to the typical yield curve, or the short-term rates are going to drop well below the long-term rates. So if this happens, where the long-term rates, which are, you see what I'm saying? The long-term rates are right here. They go above the short-term rates. That still means you're making money in the short-term rates, 4.5%. That just means the long-term rates, there will be some volatility for long-term bonds, big time. but then you'll be getting higher rates at that point. But there'll be some more pain to feel in the interim while the rates are going up. I just don't expect that because the long-term rates, I just don't think this economy is on good ground. And as such, to make the cost to borrow much more higher for people, businesses and families, frankly, I just don't see that happen. I just don't. I don't think there's enough economic activity. The engine of economic growth, I don't think, is here to warrant higher long-term rates for a considerable amount of time. I just don't. So the only thing I could see in this guy, short-term rates, instead of long-term rates eclipsing them, short-term rates would go down and make the yield curve what it typically is, which is longer rates pay more than short-term rates. But it's going to be contingent, my perspective, on the short-term rates dropping. I just don't see that the long-term rates are going to be surpassed. But it surpass the short-term rates. We're talking 6-7%. I don't see it. I literally could be wrong. I don't know. Anyway, so the point being is, let's just say the short-term rates drop. Well, now he's not at 4% anymore. Now he's at 2%. Well, we have to reconvene at that point. And I mean, can we still sit at 2% T-bills, 2%, 1-year T-bonds, treasury bonds for a year, and make it work in terms of the rate of return he's getting relative to his spending? I don't know. Well, that's why you do annual reviews. I don't know. But the other side of this would be to say, well, let's just invest here so we can get 5.3. Yeah, don't forget, this is not excluded from the risk of short-term rates dropping, long-term rates going up either. This still has risk inherent in here. You're just not getting enough return for the risk if you're about to retire, in my opinion, especially if you're heavy on stocks. I just don't see it. Now, we can make an argument heavy on bonds doesn't make sense either, too, given the short-term rates are low or high. I get that 100%, dude. I mean, fixed annuities look great to me because you're locking in your money, 5 years with a guaranteed, what I saw, 4.5, 5, something like that. Now, the drawback about fixed annuities is when you have access to the cash. You see what I'm saying? So that's the issue. Every annuity is a different animal. But, man, keep it safe, simple, and secure. We can't afford in the beginning of retirement or the closing in on retirement of 2008. I caution you to remember what it was like in 2008, man. There was a reason you could buy condos in the beach in Florida for freaking pennies on the dollar because everyone was so heavily leveraged that they had to sell everything to pay their bills. And they're selling it for freaking literally pennies on the dollar. Could that happen again? I don't know. But that meant they had to sell so what happened? They lost their job. They couldn't afford the debt payment anymore on the condos they had on the beach in Florida or Phoenix or Las Vegas. So they had to sell those properties, just get out from underneath them because they couldn't afford the debt anymore. Then they had to come up they had to make their property whole. They had to bring cash to the table, so they had to sell their stocks. Dude, maybe you have a different exposure to 2008 than I did. But as someone who's in the business and dealing with clients back then, that's freaking horrible, dude. That's Great Depression time for a lot of people. And I don't know how many people took their own lives because of that. I don't know. But I know some people did. And safe, secure, and simple, dude. I love your thoughts. We'll see you.